Okay, this is chapter 1 for advanced accounting, and it's just the introduction into equity method accounting and accounting for acquisitions. So we're going to do one out of the textbook that deals with what if it is just simply an asset acquisition, meaning that that company no longer exists, we acquire all of their assets, or then the second part of it will say, what if we just acquire all of their stock? Then what journal entry do we do? So we're focused on a journal entry. Now they give us their assets, and I'm going to just go ahead and read them and put them into my journal entry. So the first part is, if it's just an asset acquisition, what would the journal entry look like? And in this particular example, the company is buying the company outright. They are paying a total amount of $15,000. And the reason that they are paying $15,000 is that some of the company's assets have appraised at higher than their book value. So I'll go through and then I'll tell you which ones those are. But again, they're paying $15,000 in cash. If we go back to the company's balance sheet, the company has cash of $1,000. So now the company that's purchasing them has $1,000 in cash. They have accounts receivable on their books for $2,000. So again, now the company that's purchasing them has accounts receivable for $2,000. They have inventory of $4,000. Again, the company that's purchasing them now gets that inventory for that dollar amount. Now then when we get to the property, plant, and equipment, the balance sheet shows the property, plant, and equipment is $10,000. That's the historical cost. But if we go down into the problem, they tell us that they appraise the property, plant, and equipment at $14,000. So the key to that is we use the appraisal. We do not use the other company's historical cost. So we come in and say, okay, property, plant, and equipment is appraised at $14,000. Okay, so we'll put that in. Then the other thing it tells us, that's it for the assets that are on the balance sheet of the investee company. But as we read it, it tells us they also value a customer list that the investee holds for $3,000. So that may seem like an odd asset to you, but if the textbook, if the problem tells us that they have valued it at that amount, we go ahead and we set that up as an intangible asset called customer list for $3,000. Then we go back to their balance sheet. The company is also assuming their liabilities. So they're going to have accounts payable worth $2,000 that they're going to owe. They have accrued liabilities worth $3,000 that they're going to owe. And then they have long-term liabilities. And those long-term liabilities are $4,000. Then we come down to, you're not going to record the stockholder equity because we are just acquiring the net assets. So net assets, and again I could put that up here, but net assets are the assets that they're acquiring less the liabilities that they're assuming. So then in that case we've got the assets less the liabilities, that's our net asset. And then how are they paying for it? They are giving cash to the investee company for the purchase price of $15,000. So then now you could look through it and say, okay, my debits equal my credits, so my journal entry is fine. Now you can have scenarios, this problem does not have it, that say they paid more than $15,000 in cash. Say they paid $16,000. When you list up their assets and you subtract out their liabilities, you'd see that they paid $1,000 more. Then we would have an asset called goodwill. And then we put goodwill for whatever that balance is to make this entry work, make our debits equal our credits. But in this case, it's just done at this, and that is our net asset acquisition. Then part B says, okay, now what if we're following equity method accounting and we acquire 100% of their stock, which we're going to see as we move into future chapters. That's going to be exactly what we do, is we acquire a certain percentage of their stock that enables us to consolidate them. But so then B says, okay, what's that journal entry if the investor purchased all of the stock of the investee's shareholders? So then in that case, what they have is they have an equity investment. Just to save on space, that equity investment is going to be worth the entire $15,000 that they pay, and then they're going to credit cash. And then this is following equity method accounting, and that's kind of the key. As we move forward, that is what we're going to use in all of our future consolidation chapters, is we're going to assume that the companies are following equity method accounting and that they are acquiring the stock of this investee company. In that case, they'd have an equity investment in the asset section of their balance sheet, and they would give up cash, or they could give up shares of stock, depending on what the problem it has. But for chapter 1, both on your take-home quiz and I believe on your test, you're going to want to know how to do both of these journal entries. So even though we don't really do this one past chapter 1, you still want to understand it. So then this is really the kind of the key that you want to get out of chapter 1.